Stop. Before you panic about silver dropping 8%, before you check the price on your phone again, before you make any decision about your position, you need to understand what just happened in the last 12 hours. Because what you're seeing on your screen right now is not reality. It's a hallucination. And I'm about to prove it to you with numbers that will change how you see this entire market. At 3 a.m. this morning, silver was trading at $74 per ounce. By 9 a.m., it had crashed to $69.50. 8% gone. Billions of dollars evaporated. The headlines are screaming crash. The forums are filling with panic. Traders are liquidating positions. And if you're watching the COMEX ticker, you're seeing exactly what the system wants you to see. But 5,000 miles away, something completely different is happening. Walk into a silver dealer in Shanghai right now. Ask them the price for immediate physical delivery. They'll tell you $88. Not 70. Not 69. 88. That's a $19 gap. On the same metal. On the same day. In the same universe. This isn't a spread. This is a broken thermometer. And what happened in those 12 hours between the crash and the bounce back to 73 just exposed the entire mechanism that's been suppressing this market for decades. The dam didn't crack. It shattered. And the water is starting to flow. Let me walk you through exactly what happened. Then I'll show you why this wasn't a crash at all. It was a trap. And the people who said it just walked into their own snare. The Chicago Mercantile Exchange raised margin requirements yesterday. If you don't speak trading language, here's what that means in English. Imagine you bought silver using borrowed money. You put down $10,000 to control $100,000 worth of metal. That's called leverage. It amplifies your gains, but it also amplifies your losses. When the exchange raises margin requirements, they're changing the rules mid-game. Suddenly, your $10,000 isn't enough anymore. They want $15,000. You have two choices. Add more cash immediately, or sell your position. Right now, at whatever price the market gives you. So what happens when they raise margins on thousands of traders at the same time? Forced liquidation. It's not that people want to sell. They have to sell. The system ejects them. And when thousands of sell orders hit the market simultaneously, price collapses. It's not supply and demand. It's mechanical. It's artificial. It's a manufactured crash. The price dropped from $74 to $69.50 in less than 6 hours. If you only looked at the chart, you'd think demand disappeared. You'd think sentiment turned bearish. You'd think the bull market broke. But that's the illusion. The chart doesn't show you what's happening in the physical world. While paper contracts were crashing in New York, physical dealers in 3 continents reported something remarkable. Buy orders flooded in. Not selling. Buying. The crash triggered the opposite reaction in the real metal market. When the price hit $70, buyers appeared like sharks smelling blood. The premium over spot, the extra amount dealers charge for actual metal, it didn't shrink during the crash. It expanded. In Shanghai, the premium went from $14 to $19. In London, dealers reported they couldn't source enough inventory to meet demand. In New York, coin shops had customers lining up before opening. The crash in paper created a buying frenzy in physical. And that tells you everything you need to know about what's actually happening here. There are 2 silver markets. One is virtual. It exists on computer screens. Traders buy and sell contracts that represent silver. These contracts promise future delivery, but 99% of them never deliver metal. They settle in cash. It's a betting market. A casino. The price moves based on leverage, margins, algorithms, and bank positioning. It has almost nothing to do with actual metal changing hands. The other market is physical. Real bars. Real coins. Industrial consumers who need silver paste for solar panels. Manufacturers who need silver contacts for electric vehicles. Citizens in countries with currency problems who want to hold something the government can't print. This market operates on supply and demand. When supply is tight and demand is high, price rises. When a billion people want metal and mines produce a finite amount, physics takes over. For decades, the paper market set the price. If silver dropped in New York, it dropped everywhere. Physical markets followed paper. But something broke in the last 6 months. The relationship severed. Paper trades at one price. Physical trades at another. And the gap keeps widening. During yesterday's crash, that gap hit $19. Let me put that in perspective. A $19 premium is 27%. Imagine going to a currency exchange and they tell you $1 costs $1.27. You'd know something catastrophic happened to the system. That's what's happening in silver right now. The paper price and the physical price have completely disconnected. Why is China paying 88 when New York shows 69? Because Chinese factories don't care what the COMEX says. They care about keeping production lines running. If a solar panel manufacturer runs out of silver paste, his entire facility shuts down. The cost of shutdown is millions of dollars per day. The cost of silver at 88 versus 69 is a rounding error. So he pays 88. He doesn't negotiate. He doesn't wait for a better price. He buys. Because the alternative is catastrophic. This is called inelastic demand. Price doesn't matter. You need it, you buy it. Industrial silver demand is inelastic. And when demand is inelastic and supply is constrained, price discovery breaks down. The market stops functioning normally. You get gaps. You get premiums. You get exactly what we're seeing today. Now let's talk about what happened after the crash. Silver bounced from 69.50 back to 73 in a matter of hours. A 5% move in the opposite direction. Why? Several theories are circulating. Some traders reported that banks who were short silver started panic buying to cover positions. When you're short, a crash should make you happy. You profit when price falls. But if you're short and you can't access physical metal to deliver, a crash becomes terrifying. Because your clients might suddenly want delivery. And if you can't deliver, you default. So the banks bought. Aggressively. At the bottom, they turned from sellers to buyers in hours. This created a short squeeze. The price rocketed back up. The crash reversed. And now we're sitting at 73, only $1 below where we started. The entire crash erased in half a day. If you blinked, you missed it. Some analysts are pointing to reports of liquidity injections. Rumors suggest $19 billion entered the system to stabilize the sell-off. Whether that's true or not, we can't confirm. But we can confirm the price action. Something stopped the cascade. Something powerful stepped in. And whatever that something was, it wasn't there to help silver go lower. Here's what this tells us. The system is fragile. The paper market can manufacture crashes through margin hikes and forced liquidation. But it can't sustain them. Because the physical market keeps bidding. And eventually, physics wins. Water finds its level. Price has to converge. Either paper rises to meet physical, or physical drops to meet paper. Given that physical buyers are paying $19 premiums, which direction do you think convergence will go? Now let's zoom out. Why does any of this matter for your position? Because the crash just accomplished something critical. It shook out weak hands. Traders who were using leverage got ejected. People who were going to sell eventually sold now. The supply of available sellers just declined dramatically. And the buyers who stayed, the physical stackers, the industrial consumers, the long-term holders, they just got stronger. Every crash in a bull market transfers metal from weak hands to strong hands. The leveraged trader sells at 69. The patient accumulator buys at 70. The trader is gone. The accumulator now owns more. This is how bulls get healthier. The weak leave. The strong consolidate. And when the next leg up begins, there are fewer sellers to provide resistance. The margin hike was supposed to kill momentum. It was supposed to scare investors. It was supposed to prove that the rally was over. But it backfired. Because the crash revealed the $19 gap. It exposed the fact that paper is fiction and physical is truth. And once that's exposed, you can't unexpose it. The illusion is broken. So what happens next? We're sitting at the end of the year. Portfolio managers are marking their books. Pension funds are preparing first quarter allocations. Industrial buyers are restocking inventory. And the physical market is telling us through premiums and buy orders that $73 is cheap. Not expensive, cheap. If you're looking at the chart and seeing volatility, you're seeing the surface. If you're looking at the China gap and the buying behavior, you're seeing the foundation. The foundation is solid. The bull market didn't break. It paused to reload. Let me address the fear directly. You're watching the price swing and wondering if you should sell. You're thinking maybe this is the top. Maybe it's time to take profits. Maybe the smart money is exiting. Let me flip that question. If the smart money was exiting, would premiums be expanding? Would China be paying $19 over spot? Would dealers report record demand during a crash? The smart money isn't exiting. The smart money is using crashes to accumulate. They're not watching the ticker. They're watching the flow of physical metal. And the flow is going one direction. East. Into strong hands. Into vaults that don't trade. Into positions that won't be shaken by volatility. Now let's talk about January. The first week of the new year is historically significant in commodity markets. It's called the January effect. Fresh capital enters. New allocations deploy. Funds that sat on the sidelines in December start executing positions in January. This happens every year. But this year, something is different. The setup is unlike anything we've seen in decades. Silver finished the year as one of the top-performing assets. It outperformed bonds. It outperformed most equities. It outperformed real estate. Investment committees at pension funds are looking at that performance and asking a question. Should we add commodities to our allocation? And if so, which one? The one that just proved itself? Or the one that disappointed? Global pension funds manage roughly $50 trillion. Their allocation to commodities sits near historic lows, maybe 1%. Their allocation to silver is effectively zero. If they decide to move just 0.1% into silver, that's $50 billion. $50 billion of buying power entering in the first weeks of January. Now compare that to the size of the silver market. Total annual mine production is worth about $25 billion at current prices. They're trying to buy 2 years of global production in 1 month. How do you fit an elephant through a keyhole? You make the keyhole bigger. How do you fit $50 billion into a $25 billion market? You expand the price. The market has to rise to a level where $50 billion can buy a meaningful stake without causing a shortage crisis. That level is much higher than 73. The crash yesterday didn't change this math. It confirmed it. Because the crash showed that even at $70, physical buyers appear instantly. The demand is real. The deficit is real. The shortage is real. And January is going to stress test the system like never before. Let's talk about your strategy. If you're holding physical silver, yesterday was a test. The crash tested your conviction. If you sold, you transferred your position to someone stronger. If you held, you passed the test. If you bought, you just made one of the best trades of the year. Because buying during panic is how generational wealth transfers happen. But here's the critical part. The bull market in silver will eventually end. Nothing goes up forever. At some point, you need an exit plan. And the exit plan isn't dollars. It's not selling silver for cash and thinking you won. Because cash is the burning building. Silver is the fire exit. If you exit the fire exit back into the burning building, you accomplished nothing. The exit plan is swapping silver for gold at the right ratio. Right now, gold trades at $4,500. Silver trades at 73. That's a ratio of roughly 62 to 1. It takes 62 ounces of silver to buy 1 ounce of gold. Historically, this ratio has been much lower. In 1980, it hit 17. In 2011, it hit 30. Geologically, silver and gold occur at a ratio of about 8 to 1 in the Earth's crust. Here's your roadmap. When the ratio is above 40, you hold silver. Silver has more upside than gold. You're in the right asset. When the ratio hits 30, you start watching closely. The market might be getting frothy. Consider swapping 20% of your silver into gold. You're locking in gains without going back to fiat. When the ratio hits 15, that's historically been mania territory. At 15 to 1, silver is overvalued relative to gold. You walk into a dealer. You hand over your silver. You walk out with 3 times as much gold as you started with. You never touched a dollar. You never paid capital gains on a cash transaction. You just rode volatility from one hard asset to another. We're not at 15 yet. We're at 62. That means silver still has enormous room to run relative to gold. The crash didn't change that. The China gap confirms that. The physical buying proves it. You're early, not late, but you have to survive the volatility. Yesterday's crash was psychological warfare. It was designed to make you doubt, to make you sell, to transfer your metal to someone with stronger hands. If you sold, you lost. If you held, you won. If you bought, you dominated. And the next crash will test you again. Because volatility isn't a bug in bull markets. It's a feature. It's how the market shakes out weak participants before the next leg up. Let me give you the final piece. The $19 gap between New York and Shanghai isn't an anomaly. It's a signal. It's the market screaming that paper is broken, that derivatives have disconnected from reality, that the price you see on your screen is a lie. The real price is being set by people who need metal, not by algorithms trading contracts. And the real price is $19 higher than the fake price. What does that tell you? It tells you that 73 is mispriced. 73 is the paper illusion. 88 is closer to reality. And if the paper price has to converge with the physical price, which direction is it going? Up. It has to go up. Not because of speculation. Not because of hype. Because of mathematics. Because of physics. Because water finds its level. The crash to 69 was a gift. It gave late entrants one more chance to buy below 70. It shook out the leveraged tourists who were going to sell at the first sign of trouble. It cleaned the market, strengthened the holders, prepared the system for the next wave. And that wave is coming in January. So here's what you do. You ignore the volatility. You watch the physical market, not the paper market. You monitor the China gap. You track dealer premiums. You follow the flow of metal. And when the ratio hits 30, you start planning your exit from silver into gold. Not into dollars. Never into dollars. From one form of money into another. From volatile to stable. From silver to gold. That's the game. The crash happened. The system exposed itself. The gap widened to $19. And if you understand what that means, you know that 73 isn't the top. It's not even the middle. It's still the beginning. The elephant is coming through the keyhole in January. And the keyhole is about to expand. Welcome to the squeeze.